Based on prevailing sentiment of the market, banks, and popular culture, yes, it's a foolish investment, but everyone's wrong. That's a good one.
This is Wall Street, Dr. Burry. If you offer us free money, we are going to take it.
My one concern is that when the bonds fail, I want to be certain of payment in case of solvency issues with your bank.
I'm sorry, are you for real? You want to bet against the housing market, and you're worried we won't pay you.
Yes, that's correct.
Improper mortgage lending practices in the early 2000s led to the subprime mortgage crisis in 2008, one of the most severe financial downturns to take place in decades. It caused $7.4 trillion in stock market paper losses and wiped out about $3.4 billion in real estate wealth. But it didn't faze this American hedge fund manager, Michael Burry, who rose to fame for creating credit default swaps and mortgage-backed bonds, betting against the housing market when everybody else expected it to keep thriving.
Is there any way to do 200 million?
Might as well say what your mama gave you.
I mean, we can, but
You
are
looking
you
good
sure?
in them jeans. I bet you look even
Absolutely.
better with me in between.
Absolutely.
I keep my
We can do
mind
that.
on my money on my mind. But you's a hell of a distraction when you shake your behind.
He made a personal profit of $100 million and more than $700 million for his remaining investors in 2008. 15 years on, he's now back on the attack. This week, Burry bet more than $1.6 billion on a Wall Street market crash through put options or bearish bets against the Nasdaq and the S&P 500. Despite this, some say it is now time to be long on the markets.
I think as we wrap up the year, we'll continue to see the economy sort of falling into this, swamp. I don't think we're necessarily going to see this big dramatic recession. Ultimately, the labor market and the dynamics of supply and demand there, and also given the strength of the consumer from a balance sheet standpoint, I think really eliminate the tail risk of having a deeper, more prolonged recession.
But for many, there is reason to be extremely cautious. The battle against inflation is far from over, and the impact of the steep rise in interest rates is not being fully felt by households and corporates yet. Ludovica Brignola, TRT World.
Well, for more on this, we're joined now by James Koutoulis from Miami in the United States. He's the CEO of Typhon Capital Management. Great to have you with us, James. To show that he's dead serious on another US meltdown, Michael Burry is reportedly using over 90% of his fund's portfolio to bet against what many still believe to be a safe and even robust economy. Firstly, do we know if he's really done that? And do we have reason to believe that a crash either on Wall Street or on the US economy is imminent?
So to the first point, we don't know his exact position. The expiry date, the strikes, whether he's, entered into option spreading positions, that's not publicly known. But listen, I personally am right along with him. I think we have a high risk of a systemic event coming in the fall here. You've had the fastest rate hikes ever. We saw in the first half of this year what that did in terms of causing bank failures due to duration mismatch. At the same time, the U.S. has engaged in massive deficit spending for many years now, and we're approaching the point where annual interest on the U.S. debt is reaching $1 trillion. At the same time, U.S. credit card debt is at $1 trillion, and again, that's all while rates are rising. And the dichotomy here of the fact that you had a housing market where a lot of people locked in very long-term low rates at the 2.5% to 3% range, and now you're seeing mortgage rates at 7% to 8%, has created a situation where the housing markets are really freezing in America. Where if you've got that long-term fixed income or fixed interest rate, why would you sell a house? Because to go anywhere new, even if you've made more money in this recent stock market melt up, and you're like, well, under normal circumstances, I would go buy a house. You're not going to do it if your borrowing costs are more than double of the property you're in currently. So, look, there's a certain amount of cash buyers that will always be there in the housing market, but I still see that market freezing up at the same time that banks are still under pressure from these rate hikes. Rate hikes always have a lagging indicator, and let's remember in 2008, you actually had further Fed hikes priced into the market 1 month before Lehman went down. So my firm, Typhon Capital, was founded in 2008. We made basically the same bets that we're making now. That while you have a Fed hike priced in, you're actually going to see a major credit event where you could actually profit making a trade similar to what the ones Barry may have made. Again, we don't know his exact positions, but there's good risk versus reward in that trade here, given how far this equity market has run up, even in the face of forward-looking, very negative earnings for the S&P.